Hi, this is Morgan Smith, partner and financial advisor with WorthPoint, and I'm your host for this video series, The 10 Myths of Investing. And I've got a special guest, uh, familiar to us if you've seen our other videos, Apollo Lupesco, Vice President, PhD with Dimensional Fund Advisor. Hey, Apollo, how you
Good
doing?
to see you, Morgan. I'm good.
Good to see you. Long time no see.
Yeah, it's been a while.
Sure has. Well, let's dive into what we're going to talk about today. A common myth out there, myth number three, is that dominant companies perform best. And I think when we think about dominant, we could, there's several ways to think about dominant companies. Companies that are big, companies that you hear all the time out there, companies that are on the media and they seem like they're dominating their industries and creating a lot of innovation and disruption and things like that. So when I think about this, my initial thoughts and when I talk to clients about this, it's well, dominant companies are dominant, but we're not companies, we're investors. And what we should be concerned about is our investment return. And I've got a feeling what we're going to talk about here is a little bit of price. What price are you paying? Price is essential in the end result, which is going to be an actual investment return. And a dominant company, for example, may not be priced right. It may be have done really well, but there's some other factors that I'm sure we're going to cover here. So uh, again, I'll ask you straight out, Apollo. Dominant companies, don't they perform the best? Is this a myth or not?
Yeah, and I think it really starts with looking at some of the big players in the market today. Look, you have Apple, which is like as of June of 2023, is the largest stock market in the world, and it's such a dominant position in phones, for example, cell phones and services, and that people are asking, well, it's so dominant, it's going to be really hard for anybody else to challenge it. So why not put more money into these really stable, robust companies? You have
Yeah,
Google.
and by the way, apologies to interrupt. The implication is Apple's so good and so dominant. I'm just going to invest everything in Apple or a
Yeah.
significant amount. So the question is there a reason why we shouldn't do that? I think that's
Exactly
kind of
right.
underlying what you're saying. Sorry to
Exactly, you
interrupt.
got it. Exactly right. Exactly right. Because I do hear a lot of folks saying that this the way to invest is really put the money into these large dominant companies because again they're so dominant, they have such a big scale, and they will continue to dominate. So let's just look at those. So to your point we want to see this from a data perspective, and we went back to 1930s, and we wanted to see which were the dominant companies in every decade, and to see, first of all, are these dominant companies continuing to be dominant year after year? So we started in the 1930s, and then we looked at the top 10 largest companies at the beginning of each decade, and each one of these companies has a particular color code to kind of represent that particular stock, and some of them don't have it. So you look at the gray ones. Well, the gray ones, it turns out, like a Lucent Technologies or Time Warner or Altria. These were only there for a single decade. So if a company is gray only, just from a visual perspective, it means that it was only there for a single decade, and then it was no longer in the top 10 largest dominant companies in the U.S. stock market. And we see today, like you have Amazon getting in there, you have Google, you have Facebook as at the end of 2020, the last decade. So you do see some of these companies really out there for the first decade. And the question, will they continue to dominate? And frankly, when you look at this just visually, you see that certainly there are companies that are dominant, that have continued to stay dominant for decades. AT&T, which is pretty much the technology stock of the time of the 1930s, it was the largest company, the largest stock in the market for 40 years. And then it was in the top four for another 30 years. So you're talking about 70 years of dominance. You look at GE. GE was one of the top three in the 1930s. And if you trace it, it actually goes all the way to the end of 2010 when it was still in the top 10. So really a long-term place. Exxon was there from the 1930s all the way to becoming the largest one in about 2010. So it is interesting to see visually that once a company it becomes large and dominant, it is quite possible. In fact, it seems likely that it would continue to stay large and dominant. So in that respect, I cannot tell you that these companies, the Amazon, the Googles, the Facebooks, the Apples, and so forth, might not continue to stay dominant. But the point that he made is really, really good, because it's ultimately not about is the company large and dominant, but what is the performance that it delivers to investors. So when you analyze that data and we looked at, here's the point, here's the time when they reached the peak, they got in the top 10, and then you backtrack a number of years, let's say you backtrack 10 years, what you see is that these top 10 largest stocks, 10 years before they became the top 10 largest company, on average, annualized, they outperformed the market. This is by how much they outperformed the market before they got in the top 10. And 10 years before they got in the top 10, they outperformed the market by about 10% per year annualized, which is huge. If the market did 10%, they did 20%. Remarkable outperformance before they got to be in the top 10. You have 5 years ahead, they were up about 19%, so significant outperformance over the market. And then 3 years before 24. So what's really interesting is that on the way to climbing the mountain and being in the top 10, these companies have fantastic performance. So they really had remarkable returns on the way up, on the way to becoming a top 10 stock. So that's kind of what we see. The question is, now that they reached the peak, they're on top of the mountain, they're the top 10 stock. What's the performance afterwards? And this is where it gets interesting. If you look at the performance afterwards, what you see is that 3 years afterwards, on average, they still outperform, but by a lot less. It's less than 1% outperformance relative to the market. 5 years later, it's actually an underperformance relative to the market by about 1%. And then when you look at 10 years afterwards, it's an underperformance of about 1.5%. So once they reach the top, they climb the mountain, what you see afterwards is basically a very different trend in performance. So the question is why? What's the intuition? What's the logic behind these numbers? And I would say there are three possible things that came to mind why that might be the case. Number one is that it's a lot easier to grow and double, let's say, from 2 billion to 4 billion. It's a lot harder to grow from 1 trillion to 2 trillion. So as you get larger and larger, you already penetrated, you already have a large user base. And like you take a Facebook or an Amazon, it's not as easy to grow at the same pace. So obviously that makes a big difference. Secondly, you do attract more scrutiny. You attack more scrutiny from the government, and you get breaking up. You got a lot more of a target on your back. And the third is so interesting because the more mature and robust these companies become, if you think of an investor, the return that he gets as an investor, it actually ties a little bit into how uncertain that company is. And the more certain something is, the higher the FICO score that somebody has, the lower the interest rate they have to pay, if we're going to make an analogy. So these companies, they become mature and they have a track record, their relative risk becomes lower to other companies that are smaller. They can grow more, but they don't have the track record that these companies have. In other words, they move from being some maybe smaller companies and value stocks to becoming large and growth. And we know that historically, this category of large growth stocks have had a lower expected return than perhaps their smaller counterparts. So to me, when I look at this, it is intuitive, and the data really suggests that just because the company will continue to stay dominant, it doesn't mean that you as an investor, you will have the same returns. But again, it's harder for a company to grow. It is something that there's more scrutiny that invites, but also that it changes characteristics and becomes something that has a relatively lesser uncertainty, which means that they also have a lower cost of capital, and investors don't really expect as much in return because I know that at least I'm getting a mature company. So, what I tell folks is like, it's great to have had Amazon, but reality is that what I love to do is find the next Amazon, because Amazon is already Amazon. I want to find the next Google, the next one, and you're not going to find the next Amazon if you buy Amazon. I mean, that's the idea. So to me, it ultimately boils down, Morgan, to the myth that great dominant companies also deliver great performance is not really what we see in the data. What we see when I look at the data is that these companies have great performance on the way up, but once they get up, as I said, part of the reason they got in the top 10, large dominant companies, because price goes up. And by then they become expensive, and investors don't really have the same returns that they've seen as they were growing up to become a top 10 stock. So, rather than just buying all Amazon, let's have some Amazon, but also try to find the next Amazon, which is certainly not Amazon itself.
Good. So a lot of neat points in there on whether or not dominant companies perform the best. And it looks like what you're saying really is that there are companies that outperform the market over time. But the data historically tells us that that doesn't last forever. And then the question becomes, well, how do I ensure or have a high likelihood of making sure I've got those up and coming companies in my portfolio? And what I talk to clients about is, well, gather up the whole marketplace,
Yep.
put that in your basket, and you're almost guaranteed to have the next best thing. But very interesting perspective. And look, we celebrate folks getting lucky every now and then and outperforming the marketplace like that, but it just, history tells us it's not going to last forever, right?
Yep.
Thanks, Apollo. Appreciate it. So this is Morgan Smith with WorthPoint with Apollo DePesco over at Dimensional Fund Advisors. Myth number 3: dominant companies perform best. Historically, the data tells us otherwise. They perform really well for a while, and then they oftentimes underperform the market moving forward. So just be careful and make sure you're building your portfolio in line with your time horizon and what your goals are. Again, thanks for joining us on our series, Top 10 Investing Myths. I can be found at worthpointinvest.com, and we will see you on our next video. Take care, Apollo. Talk to you soon.
Bye-bye.